Well, hello everyone. Welcome to the latest in the Teknion Data Solutions Data Strategy webinar series. Today we're going to be talking about data governance, and it is my good pleasure to introduce you to the head of the Teknion Data Governance practice, David Hendrawirawan. David comes to us from years of doing consulting with places like Deloitte, and we're very excited to have him. He has a lot of experience around data governance, and particularly data governance in the world of information crisis. So David, before I hand over to you, just a small piece of housekeeping. If you have questions that arise during the webinar, please use the question and answer option within the Zoom webinar to post your questions, and then we'll collate them and answer them at the end. So use the question and answer for any questions you have. David, over to you.
Yes, thank you very much, Michael. Can you hear me?
You're good, David.
Good. So thank you, everyone. I am excited to be with you today. And just to give you a quick introduction of myself, as Michael mentioned, I have been working as a leader and as a consultant to deliver data analytics, risk management, and regulatory advisory services. I've been focusing on serving banks and financial services institutions, as well as firms in heavily regulated industries. And my current role is to expand Teknion's data governance practice as a critical piece of our overall data and analytics solutions. And prior to Teknion, I've spent several years with Deloitte & Touche, as well as with Dell Technologies in their enterprise architecture function. So today we're going to speak about data governance. And I just want to take a moment to ground us in why data governance and what do we mean by data governance? Because to many people, data governance could mean different things. Many years ago, data governance used to be more focused around data quality and establishing trust in the data. And then we begin to see the emergence of data catalog so that people can find and access the right information, all the way to the ethical use and brand reputation implication of using data in your products and services. So what used to be a narrow definition now has expanded across multiple leaders in the company. As this diagram is showing you, there are many leaders that has their own set of data objectives, that their own set of risk and regulations that they have to comply with. So they come up with their own processes and even their own data cataloging tools. They call it different names, GRC tool or CMDB or metadata management. And we have adopted the view that in order to sustain this, in order to have a lean and agile governance framework, we apply what we call govern by design, which is that we embed all of the principles and rigors of trust, safety, and sustainability in every design decisions and our methodology for delivering services to all of your data pipeline components. A quick agenda for today. We are going to look at the financial services industry environment, specifically with the current response to COVID-19. But we don't want to stop there because we can actually learn from the experience. So we will be looking at a comparison to the Great Recession of 2007 and 2009. And this is useful for us to understand the nature of a crisis. Every crisis have their own unique characteristic, but when it comes to how we handle it, especially in the area of how information plays an important role for decision makers during a crisis, we can draw a lot of valuable lessons from that time so that we can understand the 3 stages of information crisis: when we respond to extreme events and market shocks, when we recover from a prolonged economic stress that follows, and finally, how do we reform so that we can have a future resilient and sustainable business models? We will then take a poll to look at a couple of different key priorities and strategic data solutions. We will go through them at a high level, but there will be an opportunity for people to indicate perhaps a number of the items that are top priority in their minds so that we can go and do a deep dive on those key priorities and strategies. Today, banks and financial services firms are heroically responding to the current crisis. They're helping customers to obtain relief while we're experiencing market shocks and while they're facing stretched operational and technological capacity. It's easy for us to be focused on the current crisis and to be overly focused on the current challenge, but when the pandemic flattens, the banks and financial services will endure a prolonged stress from extended business challenges such as mass credit defaults and bankruptcy across sector, high unemployment, and economic contraction. Therefore, it's important for us to understand what's going to be coming in the aftershocks and the afterwaves of this current crisis, not just the current problem. So just to share some of perspective about the current crisis, as we all are experiencing disruptions, everybody's wondering, how are we going to recover? How fast can we recover? And there's a lot of discussion about the recovery curve. There is the L curve, where essentially the economy will not be recovering to the normal state almost at all. Or you may have the U curve, where the recovery will be very slow, or the V curve. And the V curve is where you have a swift drop, but then you will quickly bounce back. At this point, of course, everybody's hoping that out of this current epidemic, we can recover quickly. And there is an article from Harvard Business Review that had shown that in the previous epidemics, all of the recovery has been V-shaped. Okay, so that gives us hope, but at the same time, that all depends on how fast we can discover testing, how fast we can make available vaccines. And there is also a recent survey. Right now, we have a lot of unemployment that's happening, and there is a PBS survey that showed that majority of the people who lost their jobs think that it will come back, because in theory, a lot of the the jobs that are lost are not necessarily lost because we have lost the economic capacity, but simply because people are hopefully temporarily having to stay at home. We also have some good signs in that our government has learned from the past crisis, and they have moved quickly to pass large stimulus. The bank sector are today much better capitalized because we have gone through a period of reform after the last crisis of 2008, 2009, and banks today are actually much better capitalized in order to withstand the future crisis. So during the 2007, 2008, we passed about $2 trillion worth of stimulus within a one-year period. And this time, the government has already moved on to pass $3 trillion worth of stimulus within a 3-month period. So, if anything, this indicates that there is definitely a learning that has been taken from the history and a sense of urgency in saving the economy. So let's look at what are the primary focus of the banks today as we are confronting the COVID-19 situation. So banks today are currently providing a lot of customer relief. So back in the past crisis, a lot of banks have been suffering from a long period of excessive risk taking, and they were part of the culprit of the past crisis. But this time, banks actually have an opportunity to really play an important role and be the hero of this episode. A lot of banks have been waiving fees and allowing early withdrawals for their customers, extending payment deadlines. They are channeling the Paycheck Protection Program for small business lenders and credit providers. We have also been cooperating with the government to extend Community Reinvestment Act that supports low-income individuals, small business, and farms. And we also, the government also is allowing banks to not necessarily writing off modification to loan terms automatically as troubled debt restructuring. realizing and recognizing that at this point, most people are experiencing disruption in their business. From regulations perspective, they're actually taking a lot of action to ease the regulatory burdens that are not necessarily considered critical during this time of stress. So examples of this include the regulatory report submission deadline that's being extended. For example, the call report submission has been extended by 30 days. The OCC has allowed real estate loan appraisals to be deferred for 120 days for loan transactions. They've also allowed banks to opt into the community banks leverage ratio that will allow banks to not follow a more stringent capital calculation requirements. Therefore, they can focus more on loaning more money to the banks, to the communities that need it. There has been a delay on the deadline for implementing CECL, or current expected credit loss, which is an accounting change that impacts a lot of community banks. And so banks are now allowed to either delay or mitigate the effects a little bit later for up to 2 years past the current deadline. And also the financial crime unit is encouraging risk-based BSA compliance process. And they're essentially saying that banks can delay some of the certain filing and some of the verification requirements, so it's going to be lowered, so that they can, again, redirect their operational focus and attention on helping their customers. All of this is being done while the banks are facing stretched IT and cyber resources. The CISA has declared that banking sector, which includes positions such as financial processors, IT service provider, and cyber operations, as essential workforce. The regulators have focused on robust business continuity plan and have also warned the banks that there's an increase in cyber criminal activities, especially as most of our banking employees are working from home, and yet they're processing more online data about the customer. And all of this naturally is stimulating a lot of opportunity for fraudulent behavior and cyber criminals. Therefore, we need to increase our situational awareness and vigilance to protect the sensitive information. So during the Great Recession of 2007 to 2009, there were a lot of mortgage failures that caused fear of systemic fallouts that spread through the entire financial system. We learned from that period that banks needed accurate information in order to make timely decisions and avoid losses. But unfortunately, we also learned that the decision makers were struggling because we don't have adequate information quality, we don't have granular data, and we don't have comprehensive risk reports that are required in order to make critical decisions. Let us look at some of that dynamic in more detail. So if we will start by looking at the interdependent triggers of the Great Recession. There is a movie called The Big Short, and this is actually a very exciting movie. It's very entertaining, and it's also very fact-based, and it teaches the lessons about the causes of the financial crisis. And it essentially circulates around 4 players who discover, before everybody else discovered, that there is a bubble, and there's a housing bubble, and that there is this domino effect that's about to happen because of the loopholes in the financial system. And so they actually placed their bets against it, and they won. They made a lot of money, and yet they were so unsatisfied because they recognized how screwed up the system has been. Unfortunately, we cannot watch this movie during this webinar, but I just wanted to throw it out there so that people can, if you're interested, maybe watch it afterwards. But for now, we're going to a little bit more boring view of the texts. But so what triggered the Great Recession? It started out with the housing bubbles that fueled speculative real estate market activity. At the same time, interest rates was very low, and that triggered a lot of consumers to borrow excessively. And also a lot of the mortgage lenders were not as regulated as they should have, and therefore they issued a lot of subprime mortgages. These risky loans and subprime mortgages are also packaged and securitized and traded as collateralized debt obligations and mortgage-backed securities. And the theory is that if you pull together a portfolio of loans and mortgages, you will be able to hedge the risk and you will be able to lower the risk of the default of individual loans. Therefore, this becomes a very supposedly safe trading instrument. Now, of course, the credit rating agencies were overrating these debt-based securities because of conflict of interest. And that allows for the financial institutions that were under-regulated to borrow and over-leverage in order to buy these toxic securities, therefore creating a vicious cycle that further financed these housing bubbles and inciting more speculations. Some of the numbers, I'm not going to read the whole statement, but you can see that essentially if we compare the house median home price from 80s and 90s compared to the numbers in 2004 and 2006, the ratio has increased significantly, meaning that a lot of home prices were appreciating at an abnormal rate, giving the homeowners the opportunity to try to finance their consumer spending by taking a second mortgage secured by the price appreciation. And those bad loans and mortgages were issued as a collateralized debt obligations, for example, and those CDOs were growing from $20 billion in 2004 to $180 billion in 2007. Eventually, as the crisis started to happen, it goes back to 20 billion again by 2008. And the credit quality of the CDOs declined significantly from 2000 to 2007. In terms of how the credit rating agencies rated them, there were 45,000 mortgage-related securities that Moody's rated as AAA, which is the top highest rating. As a comparison, only 6 US private companies ever had such top rating. And by the end of 2009, over half of those AAA CDOs were impaired to the junk status by the credit rating agencies, confirming the fact that during the bubbles, they were overrating them. And finally, we saw that during the 2004 to 2007, before the bubble burst, the top 5 US investment banks were accumulating over $4.1 trillion in debt, or about 30% of US nominal GDP for 2007. So unlike COVID, there were a lot of self-inflicted risk-taking behavior that built up during the past crisis. And financial service institutions and banks were mostly part of the culprit back then. However, today, we are facing a different situation. We are now much more better capitalized. Banks are better capitalized and able to withstand. However, this time the shock from COVID, it has happened extremely fast. It's very widespread, and there's a lot of uncertainty as to if and when we can get access to the mass testing and vaccines. And so the crises are both different. However, there is one similar factor in that in both crises, critical decisions must be made with very little information based on imperfect data. Hence, we call this the information crisis. So if we look at the recession timeline, it started off with the New Century, which is a real estate investment company that held a lot of the subprime loans. They went bankrupt. And this propagated the subprime crisis. The federal funds rates was immediately reduced in order to restore liquidity and confidence in the market. And the Dow Jones, as of October 2007, was still climbing up and hitting its peak at 14,000. Following that, we started to see the Congress passing the Economic Stimulus Act, as well as the Housing and Economic Recovery Act. And these were targeted primarily to save the homeowners that are struggling to pay their mortgage. Okay, we are at this stage seeing a lot of the saving activity for the homeowners, so for the people who do have bad loans. But we are about to see the next wave where the banks that are holding a lot of these loans, especially the ones that are packaged as collaterals, they have been borrowing a lot of money in order to buy these toxic assets. And that resulted in Bear Stearns, for example, going bankrupt and becoming acquired by JP Morgan. Then in September 2008, there's a culmination of many different things. Fannie and Freddie, as well as AIG, were taken over by the government. Lehman Brothers and Washington Mutual went bankrupt. Merrill Lynch was bought by Bank of America, while Goldman Sachs and Morgan Stanley converted from investment bank to bank holding company so that they can be subjected to the protection of the government, but also they're going to be subjected to higher regulation. The government eventually passed the Emergency Economic Stabilization Act, or AKA TARP, where they can buy up to 700 billion worth of debts in order to finance the companies that are about to go bust. Citigroup, General Motors, Chrysler, Bank of America, these institutions that are too big to fail are beginning to receive the bailouts. The Congress eventually approved further American Recovery and Reinvestment Act, and the Dow Jones hit the lowest point around March 2009 at the 6,400. Interestingly, by June 2009, the National Economic Institution actually declared that the Great Recession is over. That does not mean that things were not still bad, but it simply means that the rate of economic contraction is starting to show bottoming effect. But by October and December of 2009, we are seeing the highest US unemployment number in 25 years, as well as the foreclosures at record level. Now, during this time, as we recover, the government is beginning to then implement reforms in order to prevent our economy from hitting the same crisis in the future. So the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed into law. The Fed also issued a final CCAR rule, which is a comprehensive capital adequacy review, requiring banks to produce annual capital plan and conduct stress testing to make sure that they have enough capital. Dow Jones eventually, after 3 years of the official end of Great Recession, reached its record high of 15,000 in August of 2012. The government also issued, in the aftermath, final capital rules and liquidity coverage ratios so that banks will maintain enough liquidity and capital to withstand future losses and downturns. The one thing that I also want to highlight at the very tail end of this, in 2014, the OCC issued their final tightened standards for risk management. This includes statements concerning risk data aggregation and reporting. So the banking regulators recognized from the 2007-2008 crisis that most banks' IT and data architecture were not adequate and were unable to aggregate risk exposures quickly and accurately and comprehensively. Because of that, banks were struggling to measure the systemic risk and concentrations across multiple dimensions, from functions, from legal entity, geography, and industry sectors. They were not able to anticipate and make timely strategic decisions, resulting in severe consequences not only to the banks, but also to the stability of the financial system as a whole. And the regulators recognized that information and data health requires significant investments, but the benefits will be realized over the long term. And as memories of the past crisis fade, banks cannot be complacent in focusing on beefing up their information and data processing capabilities. And that's the reason why the law was published in 2014, but it's actually not just starting in 2014. A lot of the focus around data has been started all the way back as early as 2008, 2009. If we roughly try to categorize these three eras, we can think of them as the first wave of crisis, where we were responding to extreme shocks, followed by a period where we're recovering from a prolonged stress, and finally a period where banks are having to reform toward a future sustainable business model. So let us look at the difference between these three phases, if you will, of information crisis. We will look at their business challenge, the information challenge, as well as some of the strategic data solution that we can consider in order to face the current and future stages of the crisis. In the first stage, as we currently are going through right now, we are still responding to shocks. There were extreme market shocks. There were a lot of liquidity shortages, people unable to pay their rent or unable to pay their loan because of the disruptions in their business. There were supply chain and operational disruptions across different sectors, especially sectors such as entertainment, travel and leisure. And there were also increased level of fraud and cyber threat that's implicating the entire landscape today. From information perspective, the thing that we need at this time, most companies are trying to focus on, is to establish trust in the information that we have. We have to make a lot of critical decisions with very little information, and sometimes there are a lot of conflicting information. So establishing trust in how we communicate it is very important. The banks need to have a much more nimble and agile process to aggregate and ensure quality in their data. There also needs to be heightened vigilance and alertness around the use of that information and the possibility of misuse or abuse of that information, either from fraudsters or cyber criminals. And finally, in the times of shocks, there are scenarios when banks will need to quickly scale up their data storage and data processing capacity up and down depending on the situation that requires it. So what are some of the strategic data solutions? Well, there are, we will talk about it in more detail in the subsequent, and we will take a poll to identify which one of these items people are going to want to focus on. But at a high level, we can talk about the fact that we need to have a governed BI and visualization, especially for those of you who have Tableau. We need to train our BI analysts so that they can embed governed principle in producing their reports, such that we can establish trust in the information on those reports. We also need to have the ability to rapidly blend and combine data and ensure quality. So we can talk about how we achieve that using solutions such as Alteryx. In the times when we need to increase our vigilance about potential fraud and cybercriminal activity, we need anomaly detection, and we need to do it in automated fashion. So we can look at the automated machine learning solutions such as DataRobot and see what kind of feature it offers to enable that. We also need to be aware of the fact that as people work from home, as sensitive information might be residing in systems that are less protected than if they were in the office, that we need to do more to protect the individual personal data and privacy. And finally, as we try to rapidly scale our data storage and processing activity, we need to take advantage of a cloud data storage technology such as Snowflake. As we move on to the next phase, as in the next aftershock of the first phase, we will be looking at a prolonged economic contraction. At that time, we may see mass credit defaults. A lot of companies that initially were not able to provide liquidity eventually may become insolvent, and they will go default on their loans. We may see sector-wide bankruptcies, especially concentrated around certain sectors like travel, entertainment, as well as oil and gas. And we will see a lot of systemic Risk, meaning that it's risk that comes out of interdependence. So as one sector falls, there's a domino effect on another sector or another set of companies or creditors. And so we have to look at the concentration of those systemic risks. What do we need from information perspective? We need more granular and more historical data to be made available so that we can look back as well as create reliable prediction as to which businesses may face challenges and make timely decision to anticipate those. Our coverage of data will need to be adaptable. So one of the important lessons from the past crisis was that architecture is very important. If you don't have an adaptable architecture, it may take too long for you to produce a report such that by the time you finish aggregating data that are changing all the time, that information will be stale and the decision makers cannot make use of it well. We also need to have comprehensive reporting, comprehensive capability to cover all of the sectors and all of the business units of the bank. And we need to have the ability to coordinate action across companies and organizations and regulators across the industry. So in order to face that, there's a couple of good strategy. Number one is about customer matching, and we can look at the fuzzy matching capability in Alteryx, for example, where you may be acquiring a lot of new data sets in order to enrich the information that you do not currently have. And not all of those may not necessarily share the same joinable keys. So you need to apply some fuzzy matching. We also can look at an agile data architecture called the Data Vault 2.0. We also can look at the industry standard data models, such as the financial industry business ontology, which can help banks to adopt similar and consistent information model that will allow them to coordinate action and speak the same language across the industry. And we also can look at the secure sharing and private data exchange that is enabled by Snowflake, for example, in order to allow companies to share data with one another in a secure manner. And finally, as we reform towards sustainability, during this phase, we will see that the society will change. The behavior and customer preferences will change. There will be heightened regulation that's going to be coming. There will be a lot of unpredictable black swans and uncertainty around what the future may be, and they may come up very, very fast. And as we all become more reliant on data and technology, back then there is a term too big to fail. That is, the biggest banks needs to be safe, because if they were to fail, they're too big, and they're going to have significant implication throughout the industry, throughout the country, and throughout the world. So this time we also have the same, but this time because we're living in an era where a lot of our products and services are so much dependent on data and technology that we have to treat them as if they're also critical infrastructure that can be too big to fail. So how do we design our architecture in such a way that we can be resilient, we can recover from not just the lack of financial resources, but also the lack of data and technological capabilities. So during this time, we need to have the ability to continuously test our resilience and perform stress testing to see our current financial conditions, not just in the current, but also predicting what could happen given the potential events of the future by using past data. We need to be able to apply model-driven development using metadata that can in real time generate changes in your data architecture. As we rely more on machine learning and artificial intelligence, there needs to be intentional effort to ensure ethics and transparency in our use of AI, and the organization overall will have to be insight-driven. So we can talk about a couple of things such as the metadata-driven automation of the enterprise data warehouse using Wordscape Red, We can look at the features within Data Robot that allows you to automate a lot of the AI or model risk management features, such as documentation and transparency. And we can also look at the AI augmented data catalog point of view from Gartner that talks about how a lot of data nowadays cannot be found because they are not cataloged well. There's not enough metadata that's maintained about them. So we have to use AI to help us discover our own data. And finally, as we look at the requirement to perform look-back analysis and potentially change the past reporting as required by the regulation, we can look at features such as time travel from Snowflake to facilitate that. So at this point, we have a dozen or so strategic data solutions. And in the last 20 minutes, we probably want to focus on just a couple of those that are much more critical to our audience. So we're going to take a poll now of those dozen or so solutions that we've shown in the pre-page. If you would please indicate which one you are going to be mostly interested in, then we can take a pulse and understand, and we will pick maybe 3 or 4. We'll just go by the order priority in terms of which topic is most popular, and we will cover those in more depth in the next 20 minutes. And don't worry, after this webinar, we definitely have an opportunity to do a follow-up, and we will open up the opportunity to reach out. And if you have certain topics that you are interested in, but we didn't get a chance to capture today. So with that, I think right now there should be a poll question that comes up on your screen. And if you would please take a few moments to look at this and indicate your top interest, we would appreciate it. All right, how are we doing on the polls, Rachel? Are you able to see the participation rate? Ah, there you are. All right, so it looks like we have governed BI and visualization, Tableau, rapid blending and data quality and customer matching from Alteryx, as well as the automated machine learning and anomaly detection being the top 3. And then if we have time, we can cover the protection of personal data and privacy. Okay, perfect. So all right, let's talk about how do we establish data trust in BI and visualization. As we talked about, again, currently we are very much focused on making critical decisions using little information, imperfect data. And it is very important to produce, not just to have the data, but also to present it in such a way that decision makers can process, right? And one of the most famous, of course, everybody's now familiar with this flatten the curve visualization that is so influential in helping the society to recognize why we need to go into the, adhere to the government ask for us to stay at home. And, visuals such as this is so powerful to communicate information, but it can also, unfortunately, with that same capacity, it can mislead, misinform, and in the worst case, it could incite panic. So there are a lot of blogs that has been written about how then do you apply good design principles to your BI and analytics, and good principles to make sure that your reports and your visualizations is useful. Some of that I've taken here include spending more time to understand your data source before using the data set. There's a lot of data that's been published on COVID itself, and a lot of people would start jumping in and making assumptions without truly understanding what the data elements mean, and that's not good. As we produce the BI visualization, it is a great practice to disclose where did our source come from, what are the assumptions that we make, as well as the data limitations in the sources that we have. It will be good to be transparent as well about what is and isn't represented. It is important that we clearly define each metric for our audience, and we should reference the terms that are correct using references such as the World Health Organization definitions or CDC glossary as example. Okay. These are the ways in which we can increase the trust in our data and the information that we present. And there are also thoughtful design decisions. For example, if we are showing new cases of COVID infection, it's best not to use the red color, because the red color tends to imply certainty of fatality, right? Well, just because somebody has contracted the disease does not mean that that person is absolutely going to end up with fatality. Some of the other design decisions, there are plenty more that we can share. We have experts, we have Tableau Zen masters. Bridget Cogley, for example, one of our Zen masters, have just presented yesterday about the use of color and the importance of that in projecting the right information in context. So we encourage you to check out her webinar recording from yesterday if you're interested in that. And some other examples includes the contextualization. So if we have absolute numbers, it's good to also include relative measures. So if we mentioned there's 1,500 mortality rate yesterday, to put it in perspective, also include the comment that this is about 1 in 2 million population. And also another example is to avoid bias, we should not just show a total cumulative cases without including how many are cured. And in the data sets that we see today, for example, don't have reliable information about the amount of people who are cured. So be careful about showing total cumulative cases, because that doesn't necessarily show a balanced perspective. Okay. So let's now shift to talk about the need to accelerate your data aggregation and data quality. So we also have performed a lot of services around solutions called Alteryx, which is a data preparation tool, and can also be used as a lightweight ETL tool. And this Alteryx has a lot of great feature when it comes to allowing you to aggregate and ensure data quality in a rapid manner. First of all, this Alteryx can allow you to access and profile data from various sources, from data warehouses, from cloud applications, from spreadsheets, and bring it into a single platform. It also has not just the exact, but also some fuzzy matching capability to easily isolate and manage non-identical duplicates. And you can adjust the parameters around those as well. It comes in with visualized data quality. So each of the column, each of the field can seamlessly be profiled and shows you the bar charts, scatter plots, and statistical distributions of the values within each field. And you also have measures of data quality that are segmented and colorized in order to show things such as completeness, if there is any issue with the data, etc. You have the ability to quickly cleanse. There are more than 45 tools within Alteryx to detect, investigate, and fix issues such as leading or trailing white spaces, duplicate values, incomplete data or nulls, as well as truncated data due to the length limitation. And finally, if you don't have all of the attributes that you need, or if you need to enrich your data with additional attribute, you can blend in third-party data sets such as Experian, TomTom, or the US Census to enrich attributes such as spatial and customer demographics. So these are just some of the examples of the features within Alteryx that we have help our clients use in order to accelerate their data aggregation and quality assurance process. One of the features that I wanted to highlight here is the customer fuzzy matching ability. So the tool came with standard features to perform inexact match, but you can also customize it by specifying the similarity threshold and the match mechanism and some other configurable options. Some of the predefined matching style includes matching names, matching nicknames, company name, address, and a phone number. And if you want to customize your matching style, you can use methods such as digits, double metaphone, with or without digits, soundex, with or without digits, and even some of in a more sophisticated manner, if you want to customize the match function, you can use methods such as Levenstein distance or Jaro distance algorithm to determine the matching parameters. Okay. And in this example view here is that we took a list of names. We then perform fuzzy match to identify duplicates. And then on the right-hand side, you can see that the match scores for Bobby Young and Robert Young being 91% or 91 scored as potential matches. Okay, so you can then define the threshold for what you consider to be more likely match versus not, and make decisions afterwards. Okay. So anomaly detection and using machine learning. We also have in a machine learning and modeling, data science is a discipline that is very, very rigorous, that requires a lot of activities from the data pre-processing to model development to the deployment and assessment or validation of the model. And there's just a lot of activities that has to be done here. We have partnered with DataRobot, and we have our Chief Data Science, Kyle Roberts, who've done a couple of webinars around DataRobot. And DataRobot has significantly automated a lot of those steps that we saw earlier involved in producing model. All you have to do is drag and drop your data sets, and DataRobot will automatically recognize the shape of your data and automatically build and evaluate hundreds of models, algorithms in their library, and then compare the result of those models so that you can define which one is the best alternative that is the best predictor. It also allows you to monitor and manage the deployment of that model so that you can make a direct decision, not just developing the model, but also applying it into production and managing the life cycle of the model. And the one nice thing, as we noticed today, we have a lot of short-term opportunists that might try to commit fraud or take advantage of the fact that we are delaying some of the deadlines around anti-money laundering requirements. So a lot of anti-money laundering, fraud, and cybersecurity use cases that typically require anomaly detection. DataRobot comes with a lot of standardized models that are ready out of the box that you can utilize. So in this example, screenshot, we typed in anomaly, and there's a number of alternative anomaly detection models that, and again, you won't have to manually know every single one of them. With DataRobot, you can just pump in your data, specify the type of models, and it will run multiple versions of the models and show you the one that has the best result. Okay. So some of the other feature within DataRobot, which is really interesting, is the ability to automatically document the model. So once you've created the model and you select the one that you believe is the best, it can automatically generate what they call the model blueprint that shows exactly how the data was wrangled, or what steps is taken during the feature engineering before producing the model. You have an automated report generation that you can click and provide you with the details around the model itself, the science behind it, and all of the necessary parameters. This screen shows you how it can select the best recommended model based on the metrics of validation that you can specify and customize. And also this shows you how, for example, you can understand why the model predicts certain things by selecting the predictions, the top 3 or lowest 3, and identify the most influential feature that result in that prediction. Okay. And finally, I'll talk about the fourth item real quick here because we're almost running out of time, but it's around protection of personal data and privacy. As we mentioned that nowadays, a lot of sensitive information may be spread between the office and home, and we need to be more vigilant in terms of protecting privacy. So some of the techniques involve allowing things such as redaction, tokenization, perturbation, substitution, and encryption or hashing. These are all data de-identification methods that we have helped our clients implement in their solution. Not all data de-identification techniques are the same. Some of them result in more or less ability to analyze the data. So in principle, the more you obfuscate or the more you protect the data, the harder it is for you to actually perform analytics or join that information. So you have to understand the use case and implement the appropriate protection approach to your data. And finally, I'm also going to mention that within Snowflake, in the cloud data warehouse, they have a good techniques such as secure views and secure joins that allows you to share the data between data provider and consumer without having to make a copy of the data. The copying technique is the old method. Now you can just define a secure view and grant access to your data consumers, which also eliminate duplicate costs of copying and storing that data, and thereby reducing attack surface. So we've gone through 4 of the dozen or so strategic solutions. Given the time, we have to stop at this point, and we'll take some questions in the last 5 minutes. But again, if you're interested to explore the topics that we did not get to talk about today, we're happy to do so. After the webinar, we're happy to schedule a follow-up with you. But so for now, we will open this up to Q&A.
And so just a reminder, within the Zoom webinar technology there, at the bottom, there's a button for question and answer if you'd like to log any questions in there. And thank you, David, a very informative talk, a history lesson, and also understanding what we can do to mitigate it for the current crisis.
Thank you, Michael.
Okay, I see no questions coming through. Either everybody completely understood you.
Yes, and I think, again, a lot of information that we presented today. In all fairness, this was the materials that we prepared today was probably designed more for a lengthier workshop. And that I'll use that then, since there's if there's no question, as kind of our tagline, which is that we don't want, what we're suggesting here is not that we have to do every single step in our strategic solutions, but rather, to be strategic, we can choose to do certain things earlier, but not forgetting the things that will happen at the latter phases of the information crisis. So for example, we may choose to do a couple of the things that are in the responding phase while conducting pilot on some of the things that we have slotted for the recovery strategy, and also doing research and proof of concept for the things that are going to be coming in the third wave of reform. So it is our hope that you will you find this useful and you find this interesting. And I know that a number of us have indicated other topics that were not necessarily addressed today. we're happy to reach out back to you in order to schedule some more time. And that's going to be our call to action. Please do let us know if you're interested in hearing more about the other solutions that we didn't get to talk to today. And we're happy to poll the result of our conversations with various folks in the closed group, so that everybody can learn from each other's experience about these solutions.
Excellent, thank you, David. And just for everybody's information, you will get an email from us with a link to the recording of the webinar, so feel free to share it with your teammates, colleagues, etc. And with that, let's draw the webinar to a close. So thank you very much for your attendance.